So I want to go and finish up with the flows. I want to talk about quad witching next month, September. What are you seeing? I know that's a big time for structural products to be expiring and puts. What are you seeing for flows for next month? And can we be in store for some more volatility?
Yeah, so quarterly expirations, as we highlighted earlier, are incredibly important, right? They are the majority of structured products and broad issuance are tied to these quarterly expirations. And they are March, June, September, and December in terms of their tenor. People look at markets, and technical analysts have long highlighted seasonality, right? And I think it's important to understand that seasonality broadly is not a magical construct. There are certain rules and certain flows that we know happen over different parts of the season that are tied to not only these expiration cycles and a lot of these structural effects that happen during different windows, but also as a function of liquidity during different periods and buyback and reinvestment based on beginning of the year, end of the year type effects. All of these things together, when you start to map them together, really do explain the majority of what we see in terms of seasonality. It's not a surprise that the most bearish period of the year is going into September expiration. It's a big quarterly expiration. The second biggest is going into March expiration from February. It's also not surprising that the third is this phenomenon of sell in May and go away, which is the May into June expiration. These periods are periods where there is significant risk in markets, and there are periods where you historically tend to see potential liquidity issues in the market. It doesn't mean that it happens every time, right? It doesn't mean that that these are the only flows that matter, but it does mean that there is a structural risk in markets once that serial month expires, right, before the quarterly expiration. And over that broad expiration cycle, there tends to be some risk. This is the same thing we talked about February to March of 2020. Again, not a surprise, right, that it happened day after Fed expiration, day before March expiration. Everybody said, well, that's ridiculous. It's COVID. Like, how can it be the options market? Well, clearly COVID was a critical piece of it. That's the spark. There was an issue, but we knew about COVID in late December, early January. What did markets do from late December through January till mid-February? They rallied. We knew about COVID. COVID wasn't an unknown reality at that point. But the circumstances of the tinderbox that really is the explosives underneath the market that created the potential risk of that 30% decline were very much a function of positioning in the options markets. And that is historically what is a major driver of the seasonality. So with that backdrop, as we go through August expiration here, important to note that there's significant risk in September, particularly in that SEP OPEX. But as we've mentioned, going into August OPEX, there's still support, much like there was going into Feb OPEX before kind of the COVID crash. But that buyback will really decline to drop off significantly as we approach August OPEX here. And then there's a period, a couple of weeks of real potential risk before you get to the back half of September, right? Expiration, like the back half of the September expiration, which is the first 2 weeks of September, where if something hasn't happened now, you start to see those Vana and Charm buyback flows again that we've talked about. So if you can start to get some liquidity issues, some volatility increases that reverse some of these Vana Charm flows, particularly, reverse also some of the buyback that we see at the end of the month from continued moves higher. There's a ton of momentum factors that also play into these. But if you can start to see these flows kind of allow for a beginning of a decline in this post OPEX period, and it accelerates, those are periods of real risk that you need to be very, very cognizant of and very, very careful of. But as I mentioned, you have a kind of short period for it to get going. After that, you have almost the opposite effect. It's not gamma effect, so it's not convex, but these buyback structural effects of the coming SEP OPEX that can really lead to significant daily, day-over-day buyback and support the markets into that. After that, we get into the historically stronger period, right? Particularly after October OPEX, where you really start to see lower liquidity, more holidays, more Vonacharm buyback. And again, with the market up what it is year to date, a significant amount of front running of the reinvestment of collateral going into the end of the year, beginning year, which drives the Santa Claus rally historically in January effects. So there's this important to understand that the factors under seasonality, not just because they're not always consistent, they're not always the same direction, despite what seasonality graphs will tell you. They're a function of other factors that tend to be correlated to seasonality, but they're not specific to the calendar explicitly. And the more you understand those things, the more you understand their probabilities to hedge risk and to be much more cognizant of those flows and that positioning. And you can be more dynamic and really generate real alpha relative to just broad market exposure.